Hi guys, welcome back to the channel. My name is Brad. This is Firefighters Financial Toolbox. Today we're talking about another dividend ETF that came up in my poll. This was mentioned by Dave over at Hidden Freedom Investing Channel. If you haven't checked his channel out, you guys, I'll link it up here. Today we're going to talk about DGRO. That is the iShares Core Dividend Growth ETF. There's a lot to like about this one, you guys. First of all, it's got a nice expense ratio of just 0.08%. As you know, iShares is the dividend portion of BlackRock Investment Corporation, who is the biggest investing corporation on planet Earth. So let's take a look at what this, how this dividend works. So why DGRO? DGRO offers low-cost exposure to U.S. stocks focused on dividend growth. I like that. Not only are you getting a dividend, but you're also looking at companies that are growing in size. Access companies that have a history of sustained dividend growth and are broadly diversified across industries. This is a fund that they say you can use the core of your portfolio to seek income. And the objective is to track the investment results of the Morningstar Dividend Growth Index. All right, so let's take a look a little bit more out here. So let's look at some of the key facts here. First of all, assets under management, 13.2 billion. So this is a nice big fund, you guys. It's been around since June of 2014. So we're looking at about a 6-year history. And as I said, it tracks the Morningstar U.S. Dividend Growth Index. Currently, it's trading at a price of about $43. So it's not a super expensive one. Now, here's some more stuff that I like about it, you guys. The number of holdings. 418. I like that. I like having more companies for me to pick when I'm investing. I don't like these dividend funds that are limited to, say, 20 to 50 companies, because then you have a larger section of your dividend coming from fewer companies. And if those companies do bad, then inevitably you do bad. This has a nice low PE ratio, you guys, of 18.52. Price to book ratio of 2.69. So those are really good numbers. And as you can see, currently it's got a yield of 2.83%. So it's a little bit lower than, say, your VYM or some of the other higher dividends. But remember, this is focusing more on the companies that grow their dividends over time. All right, so let's take a look at the holdings. So the top 10 holdings. Now this is as of this month here, November 2020. So if you're watching this in the future, it could very well be different. And hey, you guys, I usually don't call this out, but if you enjoy my videos, would you do me a favor and drop me a like, because it really helps the algorithm. All right, enough of that. Let's get back to the holdings. The biggest holding here is JP Morgan Chase at about 3%. And then we've got Chevron at about almost 3%, Microsoft almost 3%, Apple 2.81%, Verizon about 2.75%, Johnson & Johnson, Pfizer, Procter & Gamble, Coca-Cola, Home Depot. So you guys, of those companies, individually I own 1, 2, 3, 4, 5 of the top 10. But I also hold those in other funds as well. So let's continue down. Let's look at the exposure breakdown of this fund. So you can see the biggest portion of this is financials at over 19.5%. But here's something that's different: is information technology is our second biggest section. And a lot of times with dividend funds, you don't have that because most of your IT doesn't pay a big dividend. We did see that they had Microsoft and Apple, which do pay dividends, but they're not huge ones. But they're also focusing on the growth of the company. Number 3 here is healthcare, about 15.5%, and then industrials, consumer staples, consumer discretionary. Utilities only makes a little over 5.5%. Communications is less than 5%. Energy makes up 4.4%. Materials, and it does hold a little bit of cash and derivatives, and it shows here 0.02% in real estate. So that's a very small portion to real estate, which I like. Because if I'm holding this in a taxable account, then it's going to kick dividends off that are not qualified. And it looks like, as a rule, except for a few very small section of this, is going to be qualified dividends, which I like. As I said, iShares is a well-known company, and that expense ratio, you guys, 0.08. I'm in. Sign me up. That was a quick down and dirty of DGRO, the iShares Core Dividend Growth ETF. Hope you guys got something out of this. If you did, like I said, drop me that like. It really helps the algorithm, gets my videos to more people. If you're not already subscribed, you know my deal. Hit the red button, ring the bell. All right, we'll see you on the next one. Thanks.